One of the best and biggest decisions you will ever make is to invest for your future and for your goals. However, very few of us jump into this with an investment strategy. And while an investment strategy is not critical to getting started investing, it can prove to be the key to winning this game. Watch this video to find out why. Hi there, I'm Michelle. Welcome to my channel where we talk money and having more of it. In this video, we are going to take a look at why an investing strategy can be a game changer for your investing success. An investing strategy is like an instruction booklet as it lays out the plan for how you're going to approach investing and what you want to achieve by it. As a result, it is a great tool for a beginner investor as well, as it gets you to think about why investing is important to you and it motivates you to take action. So let's take a look at what a typical investment strategy includes. The first consideration to include in your investing strategy is how you are going to maximize your money. And this simply means investing as tax efficiently as possible. The first tax efficient vehicle we have available to us is our pension. In the UK, we invest in our pension in before tax money. So this money we haven't paid tax on. And while we will eventually pay tax on our pension when we draw it out, as we're trying to grow our pension as much as possible in the beginning, as quickly as possible, every little bit extra at this point in time counts. The thing to remember about your pension is you cannot access it without paying a penalty before the statutory age, which is currently 55. Under the current tax regime in the UK, we can invest up to $40,000 per year into our pension. And this assumes that you earn at least 40 or more. The second tax efficient vehicle is the ISA. We invest into our ISA using after-tax money, so we've already paid tax on this money. But the assets we buy in our ISA are not going to be subject to tax in terms of increases in their values or the profits we make if we sell them, in addition to the income they provide to us by way of interest or dividends. And the thing about the ISA is you can access it whenever you want. But ideally, you don't want to access it for at least 5 years because you want to give your assets the chance to at least grow. Under the current tax regime, we can invest up to $20,000 into our ISA per tax year. Now, the real decision that you want to include in your investment strategy is how you're going to allocate your investing between these two tax-efficient vehicles. And ideally, you want to maximize both, but it isn't always possible to have £60,000 per year to invest. So for normal investors or the average investor, we have to make a decision as to where we're going to allocate. And this decision will be very much driven by our goals and our timeline to reach them. And once we've made that decision, we document that in our investment strategy as a first step of our plan. The second element of the investing strategy is quantifying what you want to achieve. And this simply means putting some numbers to it. The key here is to have clear goals, a clear timeline for reaching those goals, and the golden number for those goals. And for retirement, there are a bunch of calculators online, and I'll put some in the notes below that you can use to see how much you will need to accumulate to have the annual amount you plan to live on in retirement. Or alternatively, you can use an easy back of the envelope calculation, and the conventional approach to doing this is to assume you could potentially earn a market-related return of, let's say, 6% per annum. And this is what has been assumed generally for this calculation. Inflation is assumed at 2%, which means your net return that you can earn on your investments is around about 4%. So let's say you want to live on $50,000 per year in retirement. That means you would have to accumulate assets of $1.25 million to give you that 4% per year. How did I calculate this? I simply said 50,000 by 25, which is the calculation you use when you're saying 50,000 divided by 4%. Basically, what you'll need to do in your retirement calculator is see how much you need to save per month to get to that 1.25, and that will be your target, which you'll then document in your investment strategy. Number one, your target retirement number, and number two, the target that you need to save per month to get there. And of course, you know your investing return, and if you can do better than that, you obviously will be able to accumulate either more than that in the same timeline or the amount you require in a shorter timeline. Now, the same goes for your other goals. First of all, you define when you will need the cash for that goal. Remember though, if your goal is to be achieved in less than 5 years, then investing in stocks and shares isn't the way to go. The market is volatile and you don't want to put your goal at risk because the market is down when you need the cash to achieve that goal. So anything less than 5 years, there are much better ways to do it in savings accounts or other short-term vehicles that don't put your money at risk. Again, there are plenty of online calculators to show you how much you would need to invest per month at an expected return so that you can achieve the amount you're going to need for your goal at the time you need it. So clearly, the more specific your goal, the easier it is to quantify. But really, whether you drill down into the minutiae or you take a more high-level approach, all you want to achieve in this second part of your investment strategy is to have the amount you want to invest per month and the goal that you want to achieve over your timeline. The third thing to include in your investing strategy is how you're going to go about investing. And this really depends on what your appetite is for investing. Do you want to do it yourself, or are you more a set and forget it type of person? And I explore these options in my video on your investing style and invite you to go and watch that. Decide which option suits your lifestyle, your risk tolerance, and your appetite for investing. So briefly, you have the option of having a financial planner work with you to determine your investing plan, or you can buy a ready-made portfolio on a robo-advisor. Lastly, you can do the self-selected portfolio approach. So once you're clear on which way you are going to go, document this in your plan. So now we have what you want to achieve and how you're going to achieve it. The next thing you're going to document in your investing strategy is how you're going to create your portfolio. Whichever route you choose, you'll be looking to create a balanced portfolio. Now, if you're doing the ready-made portfolio or the self-invested route approach, you also want to keep your costs as low as possible. And most investors who are doing the self-invested approach look to using index tracker funds and exchange-traded funds to doing that. Index funds and ETFs are termed passive funds, as there's no manager actively trying to beat the market. These index funds basically look to match their benchmark indices and they don't do anything to try and outperform it. So this is a low-cost, simple approach. It makes sense as a DIY investor to have a core part of your portfolio invested in index tracker funds, which cover global equities and possibly also global bonds if you're looking to put some lower risk assets into your portfolio. And depending on the stage of your investing journey, potentially you may be near retirement, bond funds in your portfolio can provide that capital preservation aspect. Our next step is to limit your individual stock picks to around 10% of your portfolio and your speculative riskier investments such as cryptocurrency to around maximum of 5%. Further considerations for putting into your portfolio is whether you want to look to only including ESG, which is environmental, social governance type of stocks, so the sustainable, environmentally kind of considerate stocks, or maybe you have another strategy you want to include where you only want to invest in women-led companies or such. Document this in your investing strategy so you know what your plan is. The final aspect to consider in your investing strategy is when you are going to invest. And while it's tempting to try and time when you get into the market, a better approach is to make investments at regular intervals. For example, set up a monthly debit order to invest in your index funds. Successful investing is not really about timing the market. It's more about giving a wide range of investments the time to grow. Believe it or not, successful investing is all about the slow and steady game. So, That is your investing plan or strategy in a nutshell. Go about documenting this and you'll know exactly why you want to invest, how you're going to do it, and what your ultimate target is going to be. So if you want to explore investing further, grab the Investing 101 guide in the notes below. Also, why don't you pop over to my website and take a look at the investing courses and the webinars on offer. If you like this video, please let me know by liking it. Share it with any other ladies who want to change their financial story, and comment below if you found anything useful or helpful. For financial education and money talk designed for women, please subscribe to my channel and hit the bell to be notified when I post a new video. Thank you very much for watching my video.